So what's a straddle minus a straddle? In other words, what's the difference between two different straddles with the same expiration? Bigger question is, why would it matter? Well, let's go have a look. Before we do, please be sure to click like and subscribe. It's very much appreciated and helps to promote the channel. So let's start with a quick review of a straddle. It's a strategy where you are going to buy a call and a put. They're going to have the same strike and the same expiration. So for example, you might buy the $100 call, let's say it's trading for $5, and maybe you buy the $100 put, also trading for $5. And in this case, we would say that you are long the $100 straddle for $10. That's just the total price paid for the call and the put. Now, most of the time, people buy straddles when they're looking for an explosive move in the stock. They're just not real sure of the direction. Or it could be for a gamma play. There's a number of different reasons that we use a straddle, but we're going to take a little different look at them today. And what we're going to do is to look at long and short straddles. So the question is, what happens if you buy one straddle and sell a straddle with a different strike, but the same expiration? Well, let's look at the $100 straddle. And here's our risk graph with the bend at 100. And I've drawn these kind of skewed for a reason that you'll see in a moment. Also, this is what's called a payoff diagram, which means that we are assuming we paid zero. And that's why the lowest point of this diagram lines up right here at 0. Normally it would line up down here at -10. But the reason I've done that is it's going to make it easier to compare deltas here in just a moment. So again, this is our 100 straddle, and let's now overlay the short 105 straddle. Remember, that's what the question is. We're going to be long one straddle and short a different straddle with the same expiration. Well, now we can kind of see what's going on. Let's start with the bend right here at our $100 strike. And if we just draw a vertical line and look left, you can see that all of the gains here from the blue line, in other words, if the stock falls, this side is going to be making money, that's the long put, is going to be exactly offset by the losses over here on the short put. So those are just going to cancel out. Those gains will cancel out with those losses. And therefore, we'll just end up with a flat line for all stock prices to the left of 100 in the resulting graph. Now let's take a look at this strike, draw a vertical line, and look to the right. Once again, you can see that all of the gains on the long straddle up here, this would be your long call, are going to be exactly offset by the losses on the short call. So all of these losses are offset by these gains. And once again, we're going to end up with a flat line in our resulting risk graph. But notice what happens here in the center. I've got 100 deltas, this angled part of the blue line, but I've also got 100 deltas right here from the short put. So I actually end up with 200 deltas between the strikes. So right there, we're going to get 2 times the amount of deltas. And other than that, we're going to get flat lines. So it should look like a vertical spread, but with 200 deltas right here in the center. And so if we overlay these two graphs, the blue and the red, we get this one right here in black. So it is a vertical spread of sorts. It's really 2 vertical spreads, and that's why we have 200 deltas right here through the center. So another way to understand a long and a short straddle with the same expiration is that it's really just 2 different vertical spreads. So again, let's assume that you buy the 100 straddle and you sell the 105 straddle. The 100 straddle means you are buying the 100 call and buying the 100 put. The short 105 straddle means you are selling the 105 call and selling the 105 put. Now let's just sum them up vertically. Take a look right here. If you're long the 100 call and short the 105, that is a bull spread. It's long the 100-105 bull spread. It's a debit spread. And over here, if you're long the 100 put and short the 105 put, it's also a bull spread. It's a credit spread. You would just be short the 100-105 put spread. But notice that they're both bull spreads, and that's why we end up with 200 deltas between the strikes. So once again, whenever we're talking about long and short straddles as a combination, you end up with a vertical spread with 2 times the amount of deltas between the strikes. So if you buy a low strike straddle, like we did buying the 100 strike, and sell a higher strike, maybe selling the 105, that's going to be a bull spread. And we've talked about that in previous videos. Anytime you buy a low strike and sell a high strike, it's a bull spread. And that's true whether you're talking about calls or puts. On the other hand, if you buy a high strike straddle, maybe the 105, and sell a lower strike, perhaps the 100, that's going to be a bear spread. And yet the bends in your spreads, in your vertical spreads, will be the same as the straddle strikes that you have chosen. And so that's how you can figure out what the resulting risk graph will look like. Okay, so a more important question is, why does this matter? As a trader, why would you be worried about some of these pricing relationships between straddles? Well, let's go back and look at the 100 straddle. So notice that as the stock price moves to the right, as it starts going higher and higher, the straddle becomes more and more profitable. Same thing to the downside. If the stock price falls, the straddle becomes more and more profitable. It needs a really big move to the upside or a really big move to the downside, and the bigger the moves, the more profitable the straddle. Well, we could also look at this a different way. What if we look at different strikes, but we look at a fixed stock price? Let's put our stock for right now here at 104, just slightly below 105, and we're looking at the 100, 105, and 110 straddles. And what do you see? As the strike moves to the right, in other words, from the black to the green, or if we had more of them drawn out here, they also become more profitable. Or as the strike moves to the left, if we move from the 105 strike down to the 100, or to the 95 or the 90s, we keep moving the strikes this way, the more profitable the straddle becomes. So as we move the strike prices higher, it's the put option that's becoming more valuable, and as we move the strike prices lower, it's the call option. And you've heard that before from other pricing principles. Lower strike calls are more valuable and higher strike puts are more valuable. And that's exactly what's happening here for the same reasons. So as a trader, whenever you're looking at different strikes, you want to take these relationships into account. So let's say that we have these three straddles that we're looking at on our broker's platform. We have the stock at 104. What do you notice? Well, as we just showed, that as we move to higher strikes, the straddle should become more valuable. As we move to lower strikes, it should also become more valuable because the lower strikes will have call options that are deeper in the money. The higher strikes will have put options that are deeper in the money. And the at the money is going to be primarily all extrinsic value. But now let's take a closer look. With the stock at 104, the $100 straddle has 4 points of intrinsic value on the call, and therefore $3.80 of extrinsic value. What about the 110 straddle? With the stock at 104, it has $6 of intrinsic value, and that leaves only $1.40 of extrinsic. So we know that the 110 straddle should be the most expensive straddle on the board, and it's actually the cheapest. And that is really the big pricing discrepancy right here. And that should stand out immediately to anybody who understands options. Now, of course, there are a number of trades we could do here that would give us an edge, but one that particularly stands out would be to buy the 110 straddle because it's relatively cheap, and sell the 105 straddle because it is relatively the most overvalued on the board. Now again, this doesn't guarantee a profit, but it's giving you a very big edge as a result. Now, could we also buy the 110 and sell the 100? Sure, that would also give you an edge, but not as big as if we sold the 105. And the reason is, again, that the 105 straddle has $6.60 of extrinsic value just for moving up 5 points in strikes. So the trade we could see here would be to buy the 110 straddle and to sell the 105. So if we do, we end up with a risk graph that looks like this. This is our current curve, let's say with 30 days to expiration. This would be our risk graph if everything were priced according to a pricing model. But because of the prices that I put up on the board, we can see that we have shifted from the red to the black. And this space in here is our edge. This is giving us a huge edge in our favor, whether the stock moves up or down. Now, of course, obviously, we'd much rather see it move down. But remember that the stock is up here at about 104, so it's already sitting in this zone. But because we have found a relative pricing discrepancy, it's given us a very big edge in our trading. And the way that we found it was to understand the pricing relationships for the differences in Straddles. And so for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.